All right, everyone, welcome to the presentation here. We're going to go ahead and discuss the DSCR loan program. Okay, so the DSCR loan program, this stands for a debt service coverage ratio loan. Okay, so what is a DSCR loan, you may be asking? The DSCR loan is a debt service coverage ratio loan. It is specific for investment properties only. And the main thing here with this program, guys, is that there is no income verification required. So as a result, there's no DTI considered, DTI being your debt to income ratio. We are strictly looking at the property's rental income in order to determine your qualification, okay? How does this program work, you may be asking? It's very simple, guys. We're gonna go ahead and dive into that here. Qualification is based on the DSCR, like I mentioned in the last slide. What is the DSCR? Remember, DSCR stands for debt service coverage ratio. Now, DSCR, it's an equation. It's your rent divided by the total mortgage payment. Okay, so that's going to give you your DSCR ratio. In this example here, we have this property. Let's say this fair market rent for this property is $4,000 a month. The total mortgage payment is $3,500 a month. So we're going to take our monthly rent and divide it by our mortgage payment. That's going to give us a DSCR ratio of 1.14. As you can see, in this case, the property qualifies for a DSCR loan. Now, so what does that mean, right? So most properties, most lenders, ideally, you'll want a DSCR ratio of at least 1.0. What does that mean? Well, that means that the rent has to at least cover the mortgage payment. So in this case, if our mortgage is $3,500, in order to achieve a DSCR of 1.0, we would need the rent to be at least $3,500 a month. Okay, so in instances to where you are buying a property where for whatever reason the rent is below the mortgage payment, our DSCR is going to be below 1.0, right? It might be 0.9, 0.8. In that case, it's not ideal. However, we can still get the deal done. The only thing to bear in mind with that is that the rate will be affected and the terms will change. Now, one thing to bear in mind is that we can use market rent, we can use pro forma, or outstanding lease agreement. So why do I mention this? Well, it's important, okay? Because if you're buying a property that's going to be delivered vacant at the close of escrow, you may be asking, well, how do we determine what the rent's going to be if there's no lease agreement? In this case, we'll order an appraisal and we're gonna go based on the fair market rent per that appraisal. Okay, now the opposite is true. Let's say, for example, if you're buying a property with a tenant already in it and they're paying $4,500 a month, well, we can use that rental agreement. We're still going to order the appraisal anyway because it's a requirement by underwriting, but if you have an outstanding lease in place, we can use that. Okay, so bear that in mind. Requirements. What are the requirements for a DSCR loan? So the first thing here is you must own a property, guys. This program is not for first-time home buyers. First-time home buyers are not allowed with this program. And the reason for that is very simple. You know, if you think about it from a common sense perspective, this program allows you to basically get into a property without verifying any, employment or income verification. So one of those, it seems very easy to qualify for this program, but the idea is that lenders don't want clients to be using this program to purchase a home for themselves, right? So you have to own a property, right? So you have to own a property in order for underwriting to allow you to qualify for this program. Now, aside from that, the minimum credit score is 620, and I say 680 plus is ideal because yes, you can qualify with a credit score of 620, but the terms aren't going to be as good. A larger down payment may be required. So generally speaking, 680 plus is where you want to be with this program. Minimum down payment is 15%. However, that does vary based on your credit score, like I mentioned earlier, and the property type, which we'll get into a little bit later. Okay, so closing costs, they average about 3 to 4% of the purchase price. That's an average. Bear in mind, depending on where you're located, if you're in California, for example, that'll probably be on the lower end of that spectrum. If you're in Florida, for example, Florida is notorious for having more expensive title and escrow fees, and your government recording fees are also a lot more expensive. So you might be on the latter end of that spectrum. Okay. Last thing here, you will need a minimum of 3 months of reserves. Again, that is subject to change just depending on the lender and your specific borrowing profile. What are reserves? Reserves are equal to 1 month of mortgage payments. So in this case, let's say we're going based off the minimum, which is the average, 3 months. That would mean that at the time of closing, the lender wants to see that you have at least 3 months worth of mortgage payments set aside. Okay, moving on here. Eligible property types. What properties are eligible for DSCR loan program? Okay, so we can do single family residences, condos, 2 to 4 unit multifamily, and 5 to 8 unit multifamily. Now, which properties are ineligible? Okay, manufactured and mobile homes, not eligible. Leasehold properties, not eligible. Assisted living facilities, not eligible. Land and agricultural properties, again, not eligible. So the reason for that, it's strictly based on the collateral. Think about it, guys. If you're a lender, you're lending someone your money. It's a substantial investment, right? At the end of the day, you have to consider that this is an investment not only for yourself, but for the lender, right? So if the collateral is not there, it is a riskier loan. Think about it. There's no income or employment verification. They're giving you this money on the premise that it's going to cash flow. That's how they're making sense of giving you the money, right? So now the second thing they're looking at is the collateral itself, right? What is the nature of the collateral, meaning the property. Manufactured and mobile homes typically do not tend to appreciate much in value, so they're not going to lend on that. Leasehold properties, there's too many complications with that. Assisted living facilities, that's technically considered a commercial property, okay, because it's business purpose. It has a business use. You're basically operating a business out of that property, so those are ineligible. We can do those on a separate program, but that'll be commercial financing. Okay, land and agricultural properties, same thing almost as the manufactured and mobile homes. The collateral is just not there. How are you going to rent out land? You know what I mean? I'm sure there's people who can correct me if I'm wrong that do rent out their land, but generally speaking, lenders do not lend on land. Okay? So who is this program for? Who is an ideal client for the DSCR loan program? Well, this program is ideal for real estate investors, of course, new and experienced. So you do not have to be an experienced investor. You don't need a portfolio of 20 properties to use this program. You can, first-time investors, welcome, by all means. As long as you own a primary residence, you bought a house using FHA, and now you want to get into, grow your portfolio, buy more properties. Well, this is the perfect program for you. Maybe you're having issues qualifying, going FHA or conventional, right, on that second property because you're DTI. This is where that program comes into place. Now, on the flip side, if you're an experienced investor, you have multiple properties under your belt, what comes with that, guys? It's complicated taxes, right? And we all know that depending on how you file your taxes, you may or may not show enough income to qualify. So this is where that comes into play. Now, who is this program not for? This program is not for first-time home buyers, guys. This is not for first-time home buyers. If you're looking for a program to qualify because you're having trouble going the traditional route, guys, it's really not that hard to qualify for conventional or FHA. At the minimum, FHA is the easiest program to qualify for. 3.5% down, 580 FICO, 2 years of employment history. If you don't have that, guys, I'm sorry, but you shouldn't be thinking about investing in real estate. Work on getting your personal finances in line first, and buy your primary residence. Then you can utilize one of these programs, okay? This program is not for someone who's looking for a minimal capital contribution, meaning your down payment. Okay, if you want to place the least amount of down payment, 0% down, this program is not for you. Okay, it's simply not. It does require more skin in the game. Why? Again, we go back to the perspective of a lender. They're giving you this loan without verifying a whole lot of information, right? So yeah, they're going to require a higher down payment. Okay, so if you don't want to put a lot of down payment down, this program is not for you. Lastly, this program is not for rate sensitive buyers. Again, kind of tying into the last point here. Thinking about it, guys, this is a very lenient program for the client, for the borrower. If you're purchasing a property, this is a very lenient program for you. What does that mean for the lender? It's more risky for them because they're not verifying that you have the income and employment, right? So they're going to command a little bit higher of an interest rate, to kind of make up for being more lenient on the guidelines. So if you're super rate sensitive, you're looking for the prime rate, you're better off going full doc on a conventional loan, okay? Why DSCR? Why would we go for a DSCR loan when you can potentially qualify for a conventional loan? Well, we'll go ahead and address that now. So, first thing here, and probably the main thing, is that there's no income verification. Okay, so this is especially useful if you're self-employed. There's no tax returns required. So, self-employed individuals, we have the hardest time qualifying. Why? It is because typically, our CPAs and our tax preparers are doing their job and making sure that we're not paying, Uncle Sam a ridiculous amount of money. Now, what does that mean for us qualifying? It means that typically the profit on our tax returns are showing very light, thus hindering our buying power, right? So this is one of the reasons why you would go DSCR, is to unlock your full buying power, and it's just based on your credit, down payment, and the property itself. Second point there, no DTI considered. So again, if you're looking to buy another property, but you have a lot of debt and not a whole lot of income on paper, this is a good solution. Second point here, streamlined closing. Okay, so typically we close these loans in about 14 to 21 days. Very aggressive when you compare it to the traditional route. You're looking at about 30 days on average to close. So that gives you a little bit more strength when you're submitting your offers and negotiating with the selling party. Okay. Third point here, you are able to close under an entity. I get this question a lot. Isaac, can I close under an entity? Can I buy under my LLC? Yes, you can do that with this program. You can close under your LLC or a corporation. Okay. Fourth point here, rates are comparable to conventional loans for investment properties. I'm not going to sit here and say that, the rates are pretty much on par with a conventional loan, as a primary residence. Whenever you're buying a primary residence, the rates are a lot better. Okay, but it is comparable to conventional for investment properties. Fifth point here, there is no maximum exposure. What does that mean? Well, it means that there's no cap on how many properties you can buy using the DSCR program. You can buy as many as you like, assuming you have the down payment and the funds to do so. There's no county loan limits on this program like you have on conventional or FHA programs. That's typically set by your county, and you're kind of capped, so to speak. So you don't have that with this program. Last point, which I think is overlooked, and it's maybe not pertinent to everyone, but these mortgages often do not populate on your personal credit. And I put in parentheses here, think of an Amex, right? So for example, if you get a business Amex card, typically that's not going to report to your personal credit unless you're derogatory, meaning if you miss a payment, if you're late on a payment, then yes, at that point, it will reflect in your personal credit. So that's an interesting thing to hear, to bear in mind, is that someone runs your credit, more than likely this mortgage is not going to populate on your credit unless you have a derogatory event, meaning you miss a mortgage payment. Okay. So with that being said, how do we get started? How do we get started with this process? Okay, so the first step is to get pre-approved. And to get pre-approved, here are the steps to do so. Number one, you'll need to complete an application, okay, a loan application. We have an online loan application, it takes about 10 to 15 minutes, like I said. Once we have your application, you fill it out in its entirety. I'm gonna go ahead and process a soft credit check. Okay, why are we going to do that? I have people ask me all the time, Isaac, can't you just give me a pre-approval based on my assets and the application? No, I cannot, I'm sorry. The reason for that is because this program is very specific to your credit score. There are so many different tiers, okay? So just depending on where your mid credit score falls, that's gonna dictate what bracket you're in, and it can really change your terms. So we have to make sure that we're being thorough and check all three bureaus. And again, we're gonna go based on your mid score, okay? So complete loan application, run a soft check. Third thing here, we'll have to verify that you have sufficient funds to close, cash to close, that meaning that's your down payment plus your closing costs. Again, we mentioned previously the minimum down payment is 15% for single family properties, 20% for 2 to 4 units, and about 25 to 30% for 5 to 8 units. And then we have your closing costs. Again, on average, it's about 3 to 4%. Okay, so we have to verify that you have enough for your down payment and your closing costs. Once we do these first 3 steps, you're pre-approved. Okay, you're ready to go. You're ready to rock and roll. You have an idea of what your buying power is. And now at this point, it's up to you and your realtor, if you have one, to go ahead and start the search for looking for some potential investment properties, okay? Fifth thing here, once you do find that perfect property, you're gonna go ahead and submit an offer, and hopefully you're gonna enter escrow and we'll go through underwriting, okay? So that's where I step in here, and I'll get back into the process with you. We're basically gonna, clear out the conditions from underwriting, whatever that may be. If you're closing under an entity, they're gonna ask for those entity documents. They're gonna ask for your credit check. They're gonna order a verification of rent or a verification of mortgage on your primary residence, just to make sure that you've been timely on your payments. And verifying where the funds came from for the down payment. After we do all that, you'll reach step number 7, which is closing escrow. And congratulations, you're gonna start collecting the rent. Okay, so join me here in this next slide here. I have a real world scenario just to kind of break this down. Okay, so now that we discussed what the program is, how it works, who it's for, why you would use it, you can see how it's starting to make sense. But I want to bring this whole video back, kind of tie it to a real world example. That way you can put it into perspective, okay? So this is a property that I actually found on Zillow. I literally just found this about an hour ago, okay? So I just Googled, some properties on Zillow. I found this one, okay? So 575 Northwest 20th Avenue. This is in Pompano Beach, Florida, okay? And again, I found this property on Zillow. The deals are out there. You just have to look. Now, I put an asterisk here. Per listing, the property will be delivered vacant. And we'll come back to this in a bit, all right? Now, here is the breakdown of the deal. Okay, so the purchase price for this property is $400,000. We're assuming we're gonna go 20% down, which breaks out to $80,000. Closing costs, again, we're gonna average it 3.5%. That comes out to $14,000. Again, so 3.5% down, 3.5% closing costs of the purchase price, $400K, comes out to $14,000. So our total cash to close for this deal is $94,000. That's your down payment plus your closing costs. Here's the mortgage breakdown, okay? So principal and interest payment, we have a monthly payment of $24.59 per month. Now we have to consider your homeowner's insurance, which is an average, okay? It's just like auto insurance, depending on who you want to go with. It can be more, it can be less. For the purpose of this example, we're using $200 a month, okay? Property taxes comes out to $695 per month. I pulled that from the county tax record. And that brings us to our total mortgage payment, which is down here, $33.54 per month. Okay, so that's known as your PITI. Whenever you're referring to your total mortgage payment, we're talking about your PITI, which is principal, interest, taxes, and insurance. Okay. Again, this is assuming a 700 credit score and an 8.5% interest rate. That's very conservative. More than likely, you'll get a better interest rate than that. But again, I'd just rather be conservative and give you guys some real numbers. Okay. Now, the last thing here is, again, I mentioned the property is vacant, right? It's going to be vacant at closing. So how do we know what this property is going to rent out for, right? Well, guys, there's so many resources out there. If you have a realtor, for example, ask your realtor, leverage your realtor. You know, if they know the area, they should be able to pull comps, you know, and not only on the value, but on how much the property can rent out for. In the case to where you don't have a realtor, or you just want to look for yourself, you know, you don't want to get a realtor involved quite yet, what you can do to vet potential properties is utilize this website here, rentometer.com. Okay, so yes, you will have to buy a membership. It's like $20 a month, I believe, but you do have 5 free searches when you create an account. Basically, what it does is it allows you to pull some rough comps on a property to see how much it can rent out for, right? So if you can see here, I did plug in the property address. So I just plugged in the property address right here, put in the amount of beds, the bed count and bath count here, and the square footage, right? So you see right here, it's a 4-bed, 2-bath, 1,406 square feet. So I put that in accordingly, right? 4 bedrooms, 1.5 baths or more. That's what it caps out on the system, okay? So just bear that in mind. And then a range, right? So you never want to put the exact range. You never want to put like 1,400 to 1,500. Give it some wiggle room, okay? So typically start off with about 100 square feet plus and minus. That'll give you some good parameters. Now we can see based on Rentometer's estimates, this property can rent out for an average of $36.40 per month. So, is this property a good deal? Will it work for DSCR? Well, remember, how do we determine our DSCR ratio? It is your rent divided by the mortgage payment, your total mortgage payment, right? So if we do the math, $36.40 a month in rent divided by $33.54 per month in your mortgage payment, that brings us to a DSCR ratio of 1.08. So congratulations, this property would work. This would be a viable option. You can buy this property going 20% down with a DSCR loan, okay? So guys, I hope that, you know, really kind of clears it up how the program works and, you know, kind of address all the main points of the program. If this is a program that you are interested in, and you do want to take the next step, well, simply put, we'll have to complete a loan application. You can go ahead and scan this QR code here, which will take you directly to my loan application. Once you submit the application and complete it, I'll be notified and I'll be working on your file directly. Why would we do this? Why would we go ahead and complete a loan application? Well, the nice thing with completing an application and getting pre-approved is that it's going to solidify your approval amount, right? That way you know exactly how much buying power you have. You never want to go out there looking at properties that you can't even qualify for. You're wasting your time and you're wasting the listing agent's time, right? Third thing here is that if you are pre-approved and you're submitting an offer, it actually strengthens your offer. Think about it, right? If you're selling your property and you're in between 2 offers, one guy's offering you $400K, let's say the other guy's offering you $400K as well. The difference is that one's pre-approved and one's not. Who are you going to accept? You're going to accept the offer that's pre-approved, right? Because they're already telling you that, yeah, we already did our homework. We already got pre-approved from our lender. So it's going to strengthen your offer. It's going to give you more leverage when you go to negotiate. And believe me, guys, I'll be right there in your corner. You know, when you submit that offer, we'll call the listing agent, present your borrowing profile to the listing agent, and, you know, just speak highly of you to help you get that offer accepted. And lastly, the main reason why you would get pre-approved is to take action. You know, I can give you all the information out there, which I'm more than happy to do, but at the end of the day, if you do want to get started investing in real estate, you have to take action. You know, take the first step, get the pre-approval, and from there, that's the hardest part. You know, getting qualified for the financing is the hardest part, and you're about halfway there, I can guarantee you that. So guys, if this is something that interests you, go ahead and complete the application. Let's get started on your pre-approval. If you inquired through Facebook, go ahead and, you know, you can also complete the application, but if you would like a more tailored response, go ahead and just hit back to the messenger flow and complete all the questions. Okay, that really helps me when, you know, I'm looking at your scenario. It gives me a better idea of kind of where you're at. And from there, you know, we can have that communication link to where we're really on the same page, right? Just to develop your game plan. So I hope this video helps, guys. And I really look forward to helping everyone. Take care.